Hi, I'm Jimmy. In this video, we are looking at the Rule of 40. It's fairly simple. We'll keep this one nice and short. So let's jump right in. Now, the Rule of 40 is a rule developed for technology companies, specifically for software as a service companies. Think of companies like Adobe, that type of company. Well, this was developed by venture capital firms. And the idea of the Rule of 40 is that they're trying to balance, let's say, both growth and profitability. Now, generally speaking, younger companies tend to lean more on the side of growth. So you might have a company growing real fast, but they're not profitable. It's easy to grow fast when you're smaller. And then as the company matures, it gets a little bit bigger, well, perhaps they become a bit more profitable, but they don't have quite the growth that they had before. Basically, the idea is that if you combine those two, you end up with a number above 40. To simplify a bit, let's look quickly at the formula. So if it's a 20% revenue growth and 25% profit margins, that's greater than 40%, it works. In fact, if you're losing 5% a year, but you're growing at 50% a year, growing revenue at 50% a year, again, that's above 40%. Therefore, for the Rule of 40, you would get a check. Now, this is not a valuation method as much as it's kind of a guideline to better understand whether or not the company is heading in the right direction. Let's call it the minimum point of happiness. So if a company is at least at 40%, when you combine those two numbers, that's a good thing. Now, one venture capital firm actually did a study to see the impact of companies that met the Rule of 40 and those that didn't. And basically, if a company met the Rule of 40 consistently on an annual basis. We're looking at annual numbers here. So it's not in any individual quarter. You're looking year over year. On an annual basis, if the company on average met it, well, those companies tend to trade at more than 2 times the multiple of a company that didn't meet that rule. So if you are looking at software as a service companies, be wary of companies that aren't meeting this rule. Now, to clarify one particular point, the biggest question around this, revenue growth is clearly quite simple. But what about profitability? Which margin are we looking at? Generally, the most widely accepted margin number to use is to focus on EBITDA margins. EBITDA is short for earnings before interest, taxes, depreciation, and amortization. And that's the most popular one, and that is before net income. So it's not the bottom line, but it's getting close. The idea here is that you eliminate some one-off numbers. So if there's a quick write-down or if the company makes an acquisition or something unique happens with that company, well, those numbers get excluded from this so you can more look at the operating business of the company. Now, if you want to be a little bit stricter, instead of you using EBITDA margins, you could use the bottom line. You could use net income profit margins. And then finally, the strictest one is if you wanted to use free cash flow profit margins. Free cash flow is let's say, the purest form of the Rule of 40 because it's now actually looking at how much cash is this company generating. Now, from the analysis that I've done, many smaller companies, their free cash flow margin ends up way short because although they might be growing very fast, free cash flow margin is often fairly negative until they become at least somewhat mature and start developing a decent amount of free cash flow. So on a personal basis, I prefer EBITDA margins. But the number one thing to keep in mind here is that this is a guideline. It's not really a rule. 40, they use that number because when they back tested it, when they analyzed all the situations that many different venture capital firms found themselves in, they found that on average, if it was 40, that was pretty good. Now, if it was 39 or 38, I'm not sure I would totally rule out a company. Or if it was 41 or 42, that might also not be a reason to keep that company in your investment considerations. So again, this is a general guideline that can be useful. The trick here is whatever formula you're going to go with, stick with it when you compare it to other companies, use the same valuation method over and over again. Now, we actually have an investing platform called investorsgrow.com, which helps us research and value companies quick and easy. If you're curious and like to get access to that, I got a link right here, link in the description below. And thank you so much for sticking with me all the way to the end of the video. I really do appreciate it. Thank you, and I'll see you in the next video.